Welcome back. Let's focus on another management, that of Suprajit Engineering. As we speak, the stock is at the high point of the day. So let's understand more about how the past quarter was and how are things going ahead. We have with us Mr. Ajith Kumar Rai, the founder and chairman of the company. Hi, Mr. Rai. Good day and good to have you on the show. Well, in the past quarter, there were a couple of one-off, non-recurring expenditure that hit you. Could you quantify that? What was the total one-off and how much of it is non-recurring? Please go ahead.
Good afternoon, and thank you for having me on your channel. I think the one-offs typically have been some, restructuring costs at Matamoros in terms of people, where one of our customers went insolvent in Europe in that quarter, so we had to write off those outstandings. And of course, a few one-offs at our new acquisition, that is, SCS. So the quantum of that, it's a little difficult to say, but I think probably it's about $1 million across various divisions on multiple counts.
Okay, all right. So $1 million approximately. Got that. I wanted to focus on a couple of verticals then. The SED vertical, you were very, very optimistic about that. And you're saying that, we could see hockey stick-like growth out there. However, in the past quarter, it's grown by close to around 20%. So should we be bracing for very strong growth even from here on? If you could give us a sense about that. And also, in this business, it's a smaller part of your business, but the street is quite bullish about it. What is the sustainable margins? Just the SED business.
You're talking about the electronics division?
Yes. Suprajit, the electronics division.
The electronics division last particular quarter has been slightly muted because of the product mix, and particularly there has been a large regrouping of the leaders within the EV space. So that probably had some effect on our overall growth numbers. But what we have said 2 years ago when we started the electronics division is that the first 2 years we'll have a hockey stick kind of a growth, which is what has happened. From nowhere, I think we have come to the current position, where every quarter we had 40 to 50% kind of a growth. That 2 year is over. Now I think it would be still very good. I think it will be a strong double-digit growth that we see going forward in the coming quarters and the coming years. And what's interesting is that we are able to get some significant new contracts for new business within India, but also for exports through our own group companies. So the overall prospect for the group is good. And in terms of the margin, I think what has happened in the quarter is that we have established a second SMT line, and the costs incurring, involved in that and setting it up and have, overseeing that entire line had added to the cost. But I think going forward, after a couple of quarters, we easily see a double-digit margin coming into that.
All right. So in the next couple of quarters, the Suprajit electronics business gets back to double-digit margins. And in terms of a revenue run rate, it starts doing around 50 crores on a quarterly basis in the coming quarter?
I think we have to give another quarter or two, but I think that is the kind of numbers that we are looking at on a steady state in a couple of quarters. Yeah.
Okay, got it. Let's focus on the debt then on the books, because I don't think you're going to be looking at any further acquisitions. So give us two numbers. One is the SCS business, which you had acquired. It looks like it's in a lot of pain. It's still struggling out there. So two numbers I want. How soon can we see this business turn around? Because you have been taking various measures out there to turn this business around, and it could be a few quarters away. So towards the end of FY26, could we see a turnaround in SCS business? And give us an updated debt number. What is it and where is it headed? Please go ahead, sir.
I think on the debt, our debt has not changed in the last 1 year. I think the mark we had about 600 plus crore of group debt. I think it remains at 600 crore even today. So there's been no new debt. Of course, the interest costs are pretty high, but debt levels have remained same. In terms of SCS, I think I need to clarify to the listeners that SCS Germany has been bought by us from insolvency. So it is already a loss-making company. It had a strategic fit with Morocco as a plant, which is, with the Tangier port being nearby. It had a very significant strategic fit. So there are two parts of the SCS transaction. One is the European side and another one is the China-Canada side. The European side is a loss-making, which is under our fold now, whereas the second one, that is the second tranche, is to be closed by end of the March, which is actually a profitable one. When you look at together, over the next 2-3 quarters, I would certainly think that it would be a catch positive situation.
Okay. So when does it turn around, sir?
That's what I'm saying. In the next 2-3 quarters, once we do both the two transactions together, I expect it to be cash positive.
So in the second half of FY26, SCS
I would
could
say
turn
second half, third quarter, probably fourth quarter, yes.
Okay, all right. Now the big burning issue is the debate is about Trump's tariffs. And 50% of your book is exports. And I think you could update me on that number, but I think close to 50% of your exports goes into the United States. He's talking about tariffs. Will that impact your business? Or, do you see some kind of way out with regard to this? Or maybe the products that you are exporting don't come under these tariffs. How do you see things shaping up?
I think as of now, you are right. Suprajit Controls Division, which does our outside of India business, has overall business of 50% of the group, of which I would say 50% is in the US. So if there are tariffs in the US for any commodities coming from any country, it will have, if it is from India, if there's a tariff, it will affect us. But I think particularly the starting point was, Mexico and Canada. That tariff threat has been put on hold for some time. Please understand, we are not the only auto component supplier supplying to US. There are a large number of guys who are supplying to it. We'll all be affected equally. I think ultimately we'll all be running to the customer and trying to get our compensation. In the process, the product cost will go up, the inflation will go up. So ultimately, we don't know what is the effect of this to the eventual consumers in the US, which could only be detrimental according to us. But we'll all be affected if it is being implemented. And I think we'll all go to the customer for compensation.
Okay, all right. But as a percentage of your total business, total revenues, it's around 25%. Would that be a fair number that goes into the United States?
In the US, maybe 30% is in US. Yeah, correct.
30%. Okay, all right. And also, what about he's sounding quite serious about putting tariffs on China? How does that impact your business?
I think our current plant operations in China, we have one facility. It is for domestic requirements, so it won't be affected. But the SCS acquisition, when it is completed, would be exports to US, but it's interestingly, strategically done through Canada. Customer picks up the product from Canada, so we won't have a tariff issue on that when we finish the acquisition. Yeah.
All right. And for the company on the whole, what kind of revenue growth are you looking at? We spoke about various divisions. Could you tell us on a consolidated basis, what kind of growth are you looking at and consolidated margins? Very quickly, sir.
I think consolidated, we have been doing double digit, including SCS. I think that will continue the double digit growth that we have been projecting all this time. We have talked about 13 to 15% consolidated EBITDA. We just crossed that in this quarter. So I think going forward with the restructuring of SCD, taking a very good shape, and for the first time SCD is having a double digit margin. We expect that 13 to 15% EBITDA margins are sustainable going forward on a consolidated basis.
Okay, all right, Mr. Rai. Thanks a lot for joining in. We'll hold you to some of these numbers and the guidance that you've given. For the time being, the street is looking ahead and explains why the stock is currently at the high point of the day. Well, time to slip into a short break. We'll get you excerpts of the conversation we had with Freshworks CEO on the company's performance in Q4, as well as the outlook going ahead.